Nickel is a raw material that for years has enjoyed steady pricing and supply. Recently, however, the Indonesian government imposed a ban on the export of raw nickel ore from its shores. The almost overnight decision caused a surge in demand from China for nickel from Philippine mining companies. Orders spiked and nickel prices rose. When the Philippine mining firms shipped nickel to China, customers there discovered that the quality of the nickel was much unlike that from Indonesia, in which additional refining processing had to be done to attain the required quality for Chinese steel companies. But as speculators were just about to be worried about shortages, the Chinese economy reported lower growth. Orders fell, nickel prices dropped, and demand leveled off. To this day, Chinese steel companies and Philippine mining firms are still reeling from the demand uncertainty. What is sure, however, is that industrial firms in both countries have learned they need to plan and respond to a volatile marketplace for what historically was a stable one. The case of the change in nickel demand complements a recent survey of supply chain executives, in which it was revealed that volatility in customer demand has become a top priority challenge. According to the survey, customer demand has become more erratic month on month from year to year, and has made it difficult for firms to meet financial targets. Moreover, from a supply standpoint, managing customer service levels and operating expenses has become harder because of changing demand. There are several factors that drive customer demand volatility. Customer loyalty. Customers have become less loyal to suppliers and are habitually switching products in search of better value. The switching causes abrupt swings in demand for firms, which normally were used to a predictable customer base. Global competition. Customers have more choices thanks to far greater access to products and services from suppliers, both local and global. As nation-states move toward free trade, the marketplace has become more competitive not only in supply, but also in price. Increasing market speculation. The marketplace has become rife with speculation. With information available in real time, buyers have the ability to leverage pricing and hedge their ordering quantities. External events, ranging from political change to economic trends, influence the market rapidly and thereby have affected demand to a more unpredictable scale. While most of these factors appear to be outside the control of the enterprise, there are ways to mitigate the impact of demand volatility. Increased demand sensing and communication capabilities. Real-time information for buyers is just as available to sellers. Firms can sense and respond to changing demand. The key to success lies in how fast the communication and response from the firm's supply chain is. An unforeseen surge in demand might require the firm to increase production with corresponding increases in orders from vendors. On the other hand, a drop in forecasted demand may necessitate a slowdown in production and cancellations of orders to suppliers. Sales, marketing, and operations decision-makers may need to frequently talk with each other. The traditional monthly meetings no longer apply. Form strong collaborative partnerships with trading partners. In coping with demand volatility, buyers and sellers have to collaborate. Arm's-length relationships with underlying distrust will not suffice. Collaborative partnerships between trading partners will need to entail quick sharing of market information and flexible responses to changing conditions. The collaboration will also need to focus on a common goal, which is to serve the final customer. Conduct what-if analyses. For major product lines and critical markets, what-if analyses for various demand scenarios are recommended. For example, if actual demand shoots up by 300%, what contingencies should be in place and what other action steps have been pre-approved for execution to serve actual demand? Should the company allow air freight of materials, or plan additional overtime for operations to respond to demand spikes? Which part of the supply chain becomes the bottleneck during highly abnormal demand? Is it warehouse space, transportation capacity, or labor resources? Does the firm have enough working capital to weather possible volatility? Customer demand volatility has become a norm, driven by factors from changing loyalties, global competition, and increasing speculation. Demand is no longer predictable, nor is it business as usual. Companies must find innovative ways to build capabilities to capture changes in customer demand patterns and create cost-effective and responsive operational structures to meet the new challenges of the volatile marketplace. Thank you for watching. Please hit the subscribe button and visit us at www.prosultsconsulting.com for more information.